3 weeks ago, tankers started vanishing from the world's busiest oil corridor. No one's making it official yet, but satellite data doesn't lie. The Strait of Hormuz, the narrow artery that moves roughly 1/5 of the world's oil, is choking. And here's the part that should make you nervous. If Hormuz stays even half shut for more than a month, some analysts say your gas prices could jump to or double by June. This isn't some distant geopolitical feud on a map. It's the pipeline that fuels your car, the factories that make your groceries, and the cargo ships that keep the global economy moving. The uncomfortable truth is that the Strait of Hormuz is probably the most strategic stretch of ocean on Earth. And right now, it's turning from a shipping lane into a flashpoint. Let's rewind. The Strait of Hormuz is only about 21 miles wide at its narrowest point, a natural bottleneck wedged between Iran and Oman. Around 20 million barrels of oil and petroleum liquids pass through that narrow channel every single day, close to 1/5 of global consumption and more than a quarter of all seaborne oil trade. The math is brutal. For every day Hormuz fully closes, the world loses oil flows roughly comparable to what the United States produces in almost 2 days. That's how fragile this system is. In January 2026, tensions between Iran and the U.S. Navy hit a tipping point after a string of anonymous drone strikes near the Iranian port of Bandar Abbas. Iran retaliated by seizing 2 tankers, claiming they were smuggling crude for Israel. Footage raced around the world. Helicopters dropping onto decks, crews detained, AIS transponders switched off. Within 48 hours, crude prices jumped by double digits. That's how tightly your daily life is wired to a conflict 6,000 miles away. But it isn't just Iran. The Red Sea, the Persian Gulf, and even shipping lanes near India have turned into overlapping proxy stages. Saudi Arabia, already juggling its own production targets, has quietly trimmed output to protect reserves and support prices. Western firms are rerouting via the Cape of Good Hope, a detour that adds roughly 2 weeks of sailing and millions of dollars in fuel costs to each voyage. Every layer of that extra cost lands in one familiar place: your wallet. That means your gas station, your airline ticket, and everything that depends on diesel to move. The situation today follows a dangerous pattern we've seen before. In the late 1980s tanker war phase of the Iran-Iraq conflict, sustained attacks and threats in the Gulf helped send energy prices sharply higher and forced the U.S. Navy to escort oil tankers to keep the lanes open. That was nearly 40 years ago, but technology hasn't changed the geography. There's still only one way out of the Persian Gulf. What has changed is the scale. Today's largest oil tankers carry several times more than many of their 1980s counterparts, and roughly 1/5 of global liquefied natural gas trade also squeezes through Hormuz. A single missile strike, a mine, or even a credible threat can be enough to spook the insurance industry. Without war risk coverage, ships don't sail, and when tankers stop moving, everything downstream starts to seize up. Here's the ticking clock. Insurance premiums for vessels crossing Hormuz have already multiplied over the last couple of months. Maritime analytics firms are tracking more and more dark or ghost ships, vessels sailing with their trackers off to avoid attention. Some flagged to Iran, others to shell companies around the Gulf. Some analysts estimate that if another major incident hits before May, we could see on the order of 5 million barrels per day knocked out of global supply. That isn't just a rise in gas prices. That's an energy shock, the kind we haven't seen since the big oil crises of the late 1970s. You might be wondering, can't other countries just produce more oil? Technically, yes, on paper, but the math doesn't really work. The U.S. Strategic Petroleum Reserve is hovering near its lowest levels since the 1980s. Saudi Arabia and the UAE have some spare capacity but are already running high and managing prices. Countries like Venezuela or Russia face sanctions and infrastructure limits. OPEC's effective spare capacity has been squeezed for years. Even if everyone opened the taps tomorrow, you still can't move that oil fast enough without Hormuz. Every alternative route, pipelines across Saudi Arabia to the Red Sea, lines into Jordan, and regional bypasses, together cover less than 1/3 of what normally flows through the strait. The world built its energy system assuming Hormuz stays open. There is no real backup plan for a full shutdown. The scary part? We may already be halfway there. Multiple drone incidents in February damaged floating terminals near Qashm Island. Iran has announced temporary naval exercises that, in practice, have closed off large parts of the northern channel. NATO and commercial satellites show tankers idling off Oman, waiting for clearance that never comes. Meanwhile, Yemen's Houthi rebels, backed by Iran, have stepped up attacks in the Bab el-Mandeb Strait, effectively trapping ships at both ends of the route. Imagine a two-lane highway suddenly cut down to one, with everyone driving 18-wheelers. That's the global oil market right now. So what happens to gas prices next? In simple terms, supply drops, prices spike, and inflation gets a second wind. Analysts from big banks and agencies are already modeling crude moving toward $150 per barrel if Hormuz fully shuts down. That kind of move would push average U.S. gas prices back toward record highs and make fuel costs across Asia and Europe brutal. Every percentage point increase in energy costs ripples through the entire economy. Air transport, shipping, agriculture, even your online shopping, all run on fuel. If logistics budgets double, prices follow. You'll notice it first in aviation surcharges and grocery deliveries, then in the cost of everything from tires to toothpaste. But there's a deeper story under those headlines. For decades, the global economy has run on just-in-time oil, minimal storage, constant flow. Refineries receive crude shipments scheduled almost down to the hour. When a choke point like Hormuz snaps, that math falls apart. Storage tanks fill up in the wrong places, shipping lanes freeze, and traders panic. Futures markets can go wild in a matter of days. In the second week of March, trading volumes for emergency fuel futures spiked several 100%. Hedge funds, airlines, and shipping giants started hoarding contracts as insurance. That's usually the moment right before retail prices catch up. If you're wondering how this hits your daily life, think back to 2022. When $100 at the pump felt like it barely filled your tank, that could feel cheap compared to what's coming. Delivery companies are already warning they'll raise fuel surcharges. Airline tickets for summer travel have climbed since January, before this crisis even fully kicked off. By June, those numbers could easily move higher again if crude holds above the $125 to $150 range. This time, though, the shockwaves could last longer. Because Hormuz isn't just about oil anymore. Roughly 1/5 of global liquefied natural gas shipments also pass through the same region. The very LNG that's been powering European homes since Russian gas supplies were cut. Disrupt that flow, and Europe's energy security gets thrown back into question overnight. Geopolitically, everyone's moving their chess pieces. China, heavily reliant on Gulf oil, has already sent naval escorts to protect some of its tankers and signal that its energy lifeline is non-negotiable. India has quietly boosted imports from Russia and other suppliers to hedge against Gulf volatility. The U.S. Fifth Fleet has redeployed additional ships and patrol aircraft into the area, calling it routine presence. It isn't routine, it's deterrence. Meanwhile, Iran is playing a longer game. Every hint of closure, every seizure or drill that slows traffic helps push global prices higher. Prices Iran can benefit from through its own exports and shadow shipments. From Tehran's perspective, instability pays. But make no mistake, a full-blown conflict helps no one. A single missile fired in the wrong place could turn a pricing crisis into something much bigger, because Hormuz doesn't just lubricate economies, it underpins the credibility of global trade itself. If insurers refuse coverage, if energy futures spiral out of control, and if governments start hoarding reserves, trust in open markets begins to crack. And once that confidence breaks, the ripples reach everything, from your mortgage rate and credit card interest to central banks' inflation targets. So what can be done? Most experts see three rough scenarios over the next few months. Scenario 1, de-escalation. Diplomacy holds. The U.S. and Gulf states broker a limited naval corridor and shipping resumes under very high insurance costs. Oil stabilizes somewhere around $100, $110 per barrel. Painful, but survivable for most economies. Scenario 2, partial closure. Sporadic attacks and seizures make insurers pull out entirely. Shipments drop by maybe 30%, prices push past $150, and governments start releasing emergency stockpiles. The US leans on its strategic reserve again. Europe re-rationates heating fuel. Inflation, which central banks thought they'd beaten, comes roaring back. Scenario 3, total shutdown. Iran's Revolutionary Guard formally closes Hormuz. We see a naval blockade, major military escalation, and likely cyber attacks on energy infrastructure. In that kind of worst-case scenario, some models put oil near or above $200, gas prices jump sharply by summer, and the modern trading system faces its toughest test since the mid-20th century. None of those scenarios are good. They're just different levels of damage. So, if you're wondering when to care about a narrow strait in the Middle East, the answer is right now. Because the Strait of Hormuz isn't just a regional choke point, it's the throat of the global economy. Every gallon you pump, every delivery truck you see, every plane crossing the sky traces back in some way to that narrow waterway. The world's prosperity depends on its arteries staying open. If that artery clogs, even briefly, every one of us feels it, whether we realize it or not. By June 2026, we'll either be talking about one of the most impressive naval diplomacy successes of this century, or we'll be living through an energy shock that forces the world to rethink how it powers itself. So the next time you drive past a gas station and see the numbers click higher, remember, it's not just inflation, it's geography, it's strategy, it's Hormuz. And right now, that tiny strait is holding a big part of the world's economy in its hands. This isn't a conspiracy, it's cause and effect, and the countdown has already begun.